Wall Street bond salespeople could sell ice to Eskimos. And with sub-zero yields globally at records, Wall Street says that's good for U.S. corporate credit. I do not think that's good. There is an enormous corporate bond bubble. There is a lot of zombie companies that we'll talk about. I'll talk about the article and tie this together. But Wall Street, the bond salespeople, Wall Street banks, profits, the whole bond selling scheme that I explained weeks ago, they still want to sell even more corporate bonds, even more credit to large corporations. What a mess. So the pile of global debt, now trading at yields below 0%, has returned to record territory at about 17 trillion after briefly dipping to nearly 10 trillion earlier in 2020, according to JP Morgan. The culprit is the staggering 17.1 trillion in collective balance sheets of four key central banks. The Federal Reserve, European Central Bank, Bank of Japan, and Bank of England's asset portfolios have grown by 5.2 trillion, and that is without an audit. That is official balance sheet, probably off balance sheets even worse, especially for the Fed, over with the special purpose vehicles over the past 12 months, mostly in a bid to offset the economic carnage caused by the pandemic. Central banks have greatly expanded their asset holdings this year by ramping up purchases and by extending emergency funding programs intended to help keep credit flowing in financial markets during the crisis. While these efforts have been viewed as widely successful, I wouldn't count it as widely successful. They've just prevented debt deflation and free market forces, and only small and medium-sized businesses on Main Street and mom and pop shops are going bankrupt, while the larger corporations are being saved. And that's government picking winners and losers, not capitalism. Other people, the article is viewing it widely successful in terms of keeping borrowing costs low, which is not a good idea because it's a credit Ponzi scheme. We already have over 270 trillion in total debt. The corporate bond bubble is well over 10 trillion in size and still growing. And it's just going to get worse, as you're going to see in the next article that I'm going to talk about, with the 1.4 trillion now size of zombie companies. The interventions have also pushed investors further into riskier assets. So this is financial repression. This is central bank financial repression. Governments and central banks. Governments do not want to cut back. Notice that the central banks are creating many trillions of currency units out of thin air. This is all over the globe to buy government bonds, to prevent the size of government from contracting, so the size of government stays the same or grows, as is the case for the U.S. and other countries. I think the U.S. now, the size of government spending is similar to Sweden. Now, off balance sheet is even larger than that, but on balance sheet, the size of U.S. government spending, according to GDP, is the size of Sweden, 45%, according to fund manager Felix Zulauf recently in an interview talking about that. And he thinks the Fed's balance sheet over the next 10 to 15 years is going to 40 trillion in size. And this is a smart investor with a very good track record long term. Interventions pushed people desperate for income into riskier assets for yield, it says, but that's for income. People are desperate for income. So that's why you have these pension funds, these bond fund managers. They're all the suckers at the table. They are all too desperate to buy anything, almost anything or almost anything with a yield. Quote, that in turn led to a tremendous amount of negative yielding debt globally. A team of JP Morgan credit analysts led by Eric Bernstein wrote in the bank's annual credit outlook, a situation viewed as putting further pressure on investors to find yield or find income wherever possible. Yields at less than 0% mean essentially that savers holding these bonds are paying the government to store their money. So this is just getting more and more ridiculous. Okay, let me just move to the next article. This next article is about America's zombie companies have racked up 1.4 trillion in debt, by Lisa Lee and Tom Cantilano from November 17th. Zombie firms are sitting on an unprecedented amount, 1.4 trillion of obligations. They were once America's corporate titans, beloved household names, case studies in success, but now they're increasingly looking like something else, zombies. And their numbers are swelling. From Boeing to Carnival Corporation, the cruise ship company, Delta Airlines, and the airlines need, round 2 or round 3 of bailouts? I'm losing count. ExxonMobil and Macy's, the department store company, many of the nation's most iconic companies, aren't earning enough cash flow to cover their interest expenses, a key criterion as most market experts define it for zombie status. Almost 200 corporations have joined the ranks of so-called zombie firms since the onset of the pandemic. Remember, I've been talking about this for years. My friend Daniel Lacalle, the hedge fund manager and economist and book author, he was talking about the European Union has had zombie firms for years with their central bank buying up corporate debt and government debt and negative interest rate policy in the European Union. So they had a ridiculous amount of zombie firms. That's getting even worse. But now the US has a ridiculous amount of zombie firms, these large corporations that are publicly traded with their cash flow problem borrowed even more debt that they cannot pay off. They can't even service it. So it goes back to what Kyle Bass has said for a while now, and he's mostly said this about China, but now it applies to the entire global economy. A rolling loan gathers no loss. So that's how they're going to prevent debt deflation and writing off losses. Companies that have too much debt, well, the credit ratings agencies won't downgrade, and the Wall Street bond selling machine, the bond salespeople, they will just reissue new debt and roll over new debt. So the amount of debt never gets paid off. The amount of debt just continues to grow in size. The Wall Street banks make profits selling even more debt. The bond salespeople earn enormous commissions. Everyone's happy except for the people who are holding the currency in savings when the Fed eventually has to buy at least some or maybe all of this toxic garbage before it blows up and causes debt deflation and bankruptcies. Almost 200 corporations joined the ranks of so-called zombie firms since the onset of the pandemic, according to a Bloomberg analysis of financial data from 3,000 of the country's largest publicly traded companies. In fact, zombie companies now account for nearly 20% of those firms. Even more stark, they've added almost $1 trillion of debt to their balance sheets in the span, bringing total obligations to $1.36 trillion. And yet Wall Street, in the previous article that just came out a couple days ago from Market Watch, wants to sell even more debt, wants to sell even more credit, and we have this enormous amount of zombie companies that can't even service their debt, and Wall Street still wants to sell more bonds, still wants to sell more debt, because you know what? It's not Wall Street's problem. It's not the bond salespeople's problem. It's not the mid-level banking manager's problem. It's not the senior banksters' problem when all this blows up a couple years from now, because they've already made their profits. The bank's earnings per share has not dropped. Look how a lot of these banks, the large banks, their revenues are right back up, their profits are right back up, and the majority of banking profits did not collapse for that long. Their revenues and profits have returned pretty freaking quickly for most of the large ones. And a lot of it is because the Fed stepped right back into the credit markets so the Wall Street bond selling scheme could restart. Selling all this toxic garbage, corporate debt, increasing credit again, and in Wall Street's trading mechanism where they do all these leveraged trades on currencies, bonds, derivatives, right back to it. Okay, the even more stark, they've added, in fact, zombie companies now account for nearly 20% of those firms, publicly traded companies, out of 3,000. Insane. Even more stark, they've added so now it's getting up to those levels, almost to those levels of the European Union that's been happening for years with negative interest rate policy in the European Union. Even more stark, they've added almost $1 trillion of debt to their balance sheets in a very short amount of time. That is nuts. Bringing total obligations to 1.36 trillion. That's more than double the roughly 500 billion that zombie companies owed at the peak of the 2008 financial crisis, as you can see there in the chart on your screen. The consequences for America's economic recovery are profound, meaning that there is no cash flow, or hardly any cash flow, to service the debt, let alone pay it off. And the Fed's almost definitely going to have to monetize this or allow deflation and debt deflation. Meanwhile, you have these deflationistas saying to hold bonds to hedge against deflation, but I guess some of them don't understand that the Fed, they're betting on the Fed doing monetary inflation and the Cantillon effect and wealth effect, the Fed creating, and other central banks creating currency units out of thin air to protect their bond trades. And the bond scheme that Wall Street is continuing and lobbying for and making sure the Fed does what it wants. The Federal Reserve's efforts to stave off a rash of bankruptcies by purchasing corporate bonds and the Fed now owns over 22,000, according to Bloomberg News, different securities, mostly bonds. By purchasing corporate bonds might very well have prevented another depression. Yeah, right. We are the real economy. There are food lines, enormous food lines, all over the country in every major metro area because politicians, all the local level politicians and bureaucrats are shutting down most of the jobs that regular Americans normally work at. But according to the stock market, we don't have a depression. But in helping, and the fake unemployment numbers and fake CPI and fake GDP, but in helping hundreds of ailing companies gain virtually unfettered access to credit markets, policymakers may inadvertently be directing the flow of capital to unproductive firms. This is crowding out and misallocation of resources, as Austrian school economists have been warning about for a long time, and creating enormous distortions, meaning these corporations, these senior corporate executives, will continue to borrow, will continue this scheme. Wall Street will continue selling bonds as long as the Fed and other central banks have the world reserve currency and can create funny money, debt-based fiat currency out of thin air. Digital debt-based fiat currency, the fiat currency credit and Ponzi scheme continue. So this bad behavior is because of debt-based fiat currency and the credit Ponzi scheme. Inadvertently be directing flow of capital to unproductive firms, depressing employment and growth for years to come, according to economists. Quote, we have to come to the point that we should ask, what are the unintended consequences, said Torsten Slock, chief economist at Apollo Global Management. Quote, the Fed, for stability reasons, decided to step in. They knew they were going to create zombie companies because they will not allow deflation. Their whole goal is to fight deflation, debt deflation, and bankruptcies for large corporations and governments, but not for small and medium-sized Main Street businesses and mom and pop. If you're too small, you're screwed. Now the question becomes, what about the companies that have been kept alive that otherwise would have gone out of business? Well, zombie firms are more commonly associated with the 1990s Japan, so that was Japanese banks that they never allowed to write down the debt and go bankrupt and have bad investments. Post-crisis Europe, or even in China in recent years, their ranks in the U.S. have been increasing for over a decade, fueled in part by years of ultra-loose monetary policy, where these large corporations, while the Fed was just lowering interest rates with all these different Fed chairmen, these corporate chief financial officers and senior corporate executives in the C-suite just kept borrowing more and more for share buybacks, bad leverage buyouts, bad mergers and acquisitions that did not produce the cash flow. And by the time there was a mess, these senior corporate executives had already gotten rich quick and were gone, and it was someone else's mess. And that's the problem that you have now with a lot of these large corporations. Zombie companies get their nickname because of their tendency to limp along, unable to earn enough. So cash flow problem, because you need cash flow to service debt and pay off debt. To dig out from under their obligations, there is a global cash flow problem, but still with sufficient access to credit to roll over their debts, because Wall Street doesn't get, the bond salespeople on Wall Street don't get in trouble for selling this stuff. And the senior corporate executives don't get in trouble for loading the balance sheet with debt, for stuffing this pig full of poison, toxic sausage, and garbage, and leaving before the real mess is made. They got rich quick, they got out in their golden parachutes, and they're gone. And the large Wall Street banks are too big to fail. They're under drag on the economy because they keep assets tied up in companies that can't afford to invest and build their businesses. Of course, not every company that becomes a zombie is destined to stay one forever. There are plenty of comeback stories, from Boston Scientific to Sprint, many firms. Those are a few small examples. There are lots and lots of zombie companies that have done the share buyback scheme, bad leverage buyouts, bad mergers and acquisitions, and now they have a cash flow problem. And all these Wall Street analysts and all these Wall Street banks that do the investment banking and sell these large corporations the bonds, and the large corporations themselves, are all giving guidance claiming the cash flow will be back 6 months, 12 months, 18 months, 24 months from now, and not to worry. And that's what the whole economy is built. George Gamenis says this. The whole economy is built on asset bubbles and confidence. Stagflate, tax, lie. Okay, well, if you want to read more about this article is really good. It's very, very in-depth about the zombie companies. We have a big problem here and the Wall Street bond selling scheme, with Wall Street bond salespeople saying, hey, look, you can't get any interest rates any other way. So here's some corporate bonds to buy. These things are eventually going to blow up. The timing on these things is tricky. There is the corporate bond ETF LQD. There is the two junk bond ETFs. There's JNK and HYG. Those are, I think, the two main junk bond ETFs. But those things may only go down a little bit. I know hedge fund managers that were short these things in February and March, and they did very, very well shorting these things, buying out of the money puts, and shorting these things for a very short amount of time before the Fed stepped in, changed the rules, announced with press releases they were doing bailouts, and the Fed didn't actually buy a lot of the corporate bonds. So for the first 3 or 4 months, the Fed didn't buy really anything. And then I think the Fed only bought about 10%. But the Fed can do manipulations without actually having to buy as of now. The high-frequency trading algorithms, which scan news headlines and press releases, they are easily tricked with manipulation by the Fed issuing press releases. And that's the markets we have now, where lots of Monday vaccine press releases about a good vaccine are released every Monday, and no one cares because stocks only, or hardly anyone cares because stocks only go up. Welcome to dystopia and how distorted and insane everything is.